Hello, everyone, and welcome back for another Indie Wealth Monthly Market Update. As always, I'm your host, Nathan Zimmerman, and today I'll be reviewing the month of June year-to-date performance, previewing second quarter earnings, and providing some things to look out for in the months ahead. So for starters, the month of June was flat for the most part. We ended the month about 1% below where we ended May, but it wasn't without some volatility. We actually saw the S&P 500 dip by about 4% in the middle of June before recovering most of that short-lived downturn by the end of the month. But if we zoom out a little bit and look at the full year, we see the S&P 500 represented above by the dark blue bar is up nearly 10% to date. And that's thanks to a 15% rally through the second quarter, despite the slightly down month of June. Now, the green and red bars represent the 11 individual sectors of the overall index. And you can see that 9 of the 11 are reporting positive performance this year, and 5 of those sectors are up 9% or more. So this is a pretty broad-based rally that's getting contributions from a lot of sectors of the market. Now, if you watch the news, you're probably hearing that it's only the technology stocks that are driving the market higher, but we can see this is simply not true. So what fueled the second quarter surge in stock prices? Well, if you follow my content, then you probably already know my answer. And yes, the answer is earnings. Now here you're looking at a chart of the earnings growth for the corporations that comprise the S&P 500 index, and you can see that recently earnings have inflected significantly higher. Throughout the second quarter, we were getting earnings reports from these corporations, and they collectively reported year-over-year earnings growth of 28%, which was more than double the 13% that Wall Street analysts had expected. And how much is the S&P 500 up over that same one-year trailing period? About 20%. Now, if I've said it once, I've said it 100 times. Over the long term, the stock market tends to follow the trajectory of earnings, and the next chart proves it. Now, the chart above shows the S&P 500 index represented by the dark blue line alongside its trailing 12 months earnings growth in light blue. You can see they follow a pretty similar path. Lots of things can move markets week to week or month to month. That's why over short periods of time, we see the market can be very volatile. A bad headline or two can create some temporary pain. But over the long run, the stock market tends to follow the earnings. If earnings are rising, investors are willing to pay more per share. And this is why I focus so heavily in these updates on earnings and not so much on whatever scary headline just ran across our televisions. So we've talked a bit about the earnings that have already been reported, but what about what earnings might look like going forward? Corporate profit momentum is expected to remain highly resilient throughout the remainder of the year. According to FactSet, consensus analyst estimates are currently projecting year-over-year earnings growth of 21% for the second quarter, 24% for the third quarter, and 21.7% for the fourth quarter. Now, it's hard to call the market a bubble when earnings are growing the way they are right now. Just expect that anytime the stock market is making new highs, someone is going to be out there calling it a bubble. But bubbles happen when the market is moving endlessly higher without earnings growth to support it, and that is not at all what we're seeing right now. If anything, recent earnings are outpacing market returns. Now, does this mean that it will be smooth sailing for the rest of the year? Well, of course not. And that's because investing in the stock market is inherently uncertain, and pullbacks can occur at any time. As long-term investors, we should expect to see several pullbacks in any given year. And in the chart above, we see the number of 5% or greater corrections in each year going all the way back to 1980. Now, the data shows us that there have been nearly 5 separate 5% pullbacks per year on average over that time frame. But on the far right, we see that in 2026, we've only experienced one so far. So I would not be surprised to see some volatility in the second half, despite the expectation of earnings continuing to grow at a strong pace. Pullbacks are normal, and we should expect to endure them many times along the way. But it's important to stay invested when they occur. We see in this chart that since 1980, there have been more than 200 of these corrections, which means there were over 200 opportunities to panic and move out of the market. But if you had just stayed invested, $10,000 invested in the S&P 500 in 1980 would be worth about $2 million today. That's about 200 times your initial investment. So I'd say it was well worth enduring 200 minor pullbacks along the way. So when that next correction arrives, and it will, just remember what we've discussed here today. Number one, corrections are quite normal. Number two, staying invested has been a very profitable strategy. Number three, stocks tend to follow the earnings over the long term. And number four, earnings growth is strong and expected to remain strong for the foreseeable future. So that's going to be all for me. Thank you for tuning in, and please feel free to share this video with any friends or family you think may find them useful. An easy way to do that is to follow Indie Wealth Advisors on Facebook and share the post with this video. I'll see you next month.